Good afternoon, Luke. Victor, good afternoon.
Good afternoon, Coach. How are you?
I'm fine. How is Haboroni today?
Haboroni, it's a bit sunny today, a bit warmer. So it's okay. And how's Lusaka today?
No, Lusaka is okay. It's actually warm. I do realize that Botswana does get, especially Haboroni, does get so cold.
Yeah, so, it does. It does.
Yeah.
Coach, look, how are you?
Fine, thanks, and you, Victor.
Yeah, I'm well.
I'm also okay. Yesterday I was so tired, guys. I don't know if you observed that. I was extremely tired. I couldn't just wait for the class to end. I was quite tired. Yeah, today it seems I have enough dragon energy in me and a bit of some steroids, so I'll manage to be alert and I also try to make you guys enjoy the class. Yesterday I was extremely tired. But how is Harare?
Harare as well.
And my favorite, my crocodile is around.
Yeah, he's around. We received some rains. I think early morning from 3 a.m. it was raining.
Oh, heavily.
Yeah, heavy.
Oh, isn't it just an introduction to winter now?
Yeah, I think so.
So today, guys, we'll be looking at financial analysis. And do this first. We'll look at financial analysis so that we pack it in our toolbox. Then later on we can continue with our standards. Most students find financial analysis easy. When they're in the exam, they normally go for any question on financial analysis. But from my observation as a marker, it's one topic that students purely do poorly. They use the information or the data that they have regurgitated, that they have extracted from the textbooks, and they would want to use it to analyze financials. So as they go into the exams, they have these predetermined ratios and what to say about the questions that they will actually face. But when you purely look at financial analysis questions, they are not asking you about things that you have mastered. They're asking you about the professional, they are testing your professional skills. They are testing your financial interpretation, not just offloading whatever data you have from your textbooks and you just give it out to the examiner. So most of the students have been getting it wrong on the financial analysis. And there are certain terminologies that, again, you have to avoid using. For example, if you're recommending, you cannot use a word should or must. I used to be told by one of my lecturers when I was preparing for top SEMA case study quite a long time ago. I used to be told that do not use these words. These words, they are reserved for God. You can't use the word must or should. You get me, look. Isn't it right?
Yes,
even when you're recommending your management, don't use the term must or should. Because there's always an element of probability. So you don't know because you're not God. And when we are looking at financial analysis, our interest is not about the past. Our interest is using these historical data sets, which we have analyzed, to project into the future. So with all these things that we are seeing, what's the future? Because we are telling our investors, in any case, Whatever you have analyzed has already happened. Whatever data set you have, you cannot change it. But then, what you're telling your investors is, with all these ratios that you have analyzed, what does the future hold? What does the future say? How is the future going to be predicted? So that they start making decisions whether to hang on or to retrace their interest in that particular organization by obvious selling off their shares. If it's employees will also need to find ways to start searching for greener pastures. So when we are looking at financial ratios, yes, they're a product of historical numbers, but what is so important, it is the assurance it actually gives you. The future assurance. Is the future okay? And sometimes we tend to over-analyze a single ratio, where you have now what they call tunnel vision. You don't want to look at other things, you just concentrate on just that thing. In the corporate world, in real life, there are quite a lot of factors that determine the future of the organization, or what has actually caused those problems that you are seeing. There are quite a number of them. So you need to know how you actually pick these numbers and interpret them in a manner that purely showcases your professional skills. So just one ratio on its own may not give you a full picture. And this is why I always reserve the best under recommendations, because you have put all these ratios and you should be able to know how you interface, link these ratios to another. So that under recommendation now, you can find ways of commingling them so that you come up with a picture that is truthful. And what I mean when I say truthful, not because you're using actual data. No, what I mean about truthful is that you are using your professional judgment to predict the future. Let me ask you this question. We have two parents. One lives in the slums of Harare, Dzavera, is it Severa? Let me check the spelling. Dzivarasewa. How do you pronounce it, Victor?
Dzivarasewa.
Okay.
Yes. Dzivarasewa. Yes.
So let's say there's a parent in Dzivarasewa and there's a school there, a community school which goes up to grade 9, for argument's sake, Dzivarasewa Community School. Then in Zimbabwe, specifically in Harare, we know there's one of the most top schools, international schools. It is called the Harare International School, isn't it? Victor?
Which one is that one?
Yes, it is.
Harare International School.
Okay.
Yeah, it's actually one of the, it's a very nice school. There's Westminster School, there's Harare International School. So let's talk about Harare International School. So we have Dzivarasewa in the slums, and these are two parents. One comes from the posh part of Harare. The other one comes from the west part of Harare. They have daughters who are apparently in the same grade, in different schools. The other one is at Harare International School. Well, the other girl is at Zavarera slum, the primary school or whatever community school. Then there's some grade, let's say grade 8. And during end of term tests or assessments, the one that is at Harare International School in mathematics got 64%. The other one who is at the Zavarera, a community school, got 90% in mathematics. These are end of term, or they are basically just the tests to assess the learners. So the other one got 90 from the Zavarera Community School, whereas the other girl got 64% in mathematics. But you know, the world we are living in is that it has now narrowed the divisions, at least virtually so. It has narrowed the divisions through technology, Facebook, so to say. So this parent who has a child at Harare International School goes on Facebook, and most parents do that. I still don't know why parents do that. Goes on Facebook and writes, "My daughter, Grace, bundle of joy," and all that. Then she got 64% in mathematics. My brilliant daughter ends there. Then there's a friend, a Facebook friend, not that they have met in the actual life, but there's a Facebook friend from the Zavarera slums. Goes there, as a first comment, sends a comment, says, "Your Grace got 64%. Mine, band of joy, Maggie, got 90% in mathematics." Then they're receiving likes and all these and comments. Now let me ask you a question, Luke and Victor. Which among those two students did well?
I think the one who is in the community school, considering the resources.
90%.
Yes, there is, yeah.
Victor?
Yeah, I think the one that is in the community school.
Okay. So you see the story here, guys. This is tunnel vision. You have just concentrated on the numbers. You did not ask pertinent questions. And that is what a professional financial analyst is supposed to ask. One, what was the average in class? Because they did not write the same exams. Tests. Remember, these were just the end of term tests. So the question is, what was the average grade in each of these classes, performance? The one who got the highest. So you need to know the highest number, the average, and the one who poorly performed. But you're not going to end there. You can also go back and in the prior whatever years to check how did Grace and Maggie perform in the last term mid exams or tests. So what I normally do with my daughter, when I receive a report form, all I'm interested in is to check the class average. Because if for example, and I always tell her this, for example, if in mathematics, the average grade was 60%, and my daughter gets 64%. Then in another subject, she gets 92%, and the average percentage class performance is 96%. I'll congratulate her in the first one where she got 64% with the class average of 60, and I'll tell her to keep working hard, and I will not shy away. I'll tell her that in this particular subject you did not perform well. Then I'll give a reason why she did not perform well. She got below the class average. What it means that she failed. So in financial analysis, this is why averages are important. I'm not going to concentrate on saying, oh, this time we got 200 million kwacha above what was recorded in the previous period on revenues. That will not be my interest. My interest would be what were the costs for getting this particular revenue that we have recorded. So then now I start looking at performance. The capital that was applied in generating that revenue, the costs that were incurred in generating that revenue, that becomes very key. Are we there?
Yes.
Yes, Coach.
So we have these ratios, but I'm not going to spend more time on them. I'll go to a document that I like most, and this document, please read it religiously. I have already sent it. I will not spend time on these ratios. So let me just go there. So that we look at that document, we look at the ratio that you need to look at, we look at how the language you should actually use when you're analyzing these financial data. I find this document to be more of a game changer. So this is on the financial ratios, like I said. As we are looking at these ratios, as we're analyzing them, please look at, say, what is the pass mark? Maybe against the budget, against the prior years. I don't like comparing with the budget because most of the time the budget has its own inherent errors, planning errors. What is the pass mark? This is the example that I was giving you. For example, 65%, a good mark to achieve in an accounting exam. So we're saying it is impossible to give an intelligent answer without knowing at least some important information for comparison, such as what is the pass mark? What is the average mark for the group being assessed? What was the best worst mark attained by other students? What were the last year's marks like? The same example about those two parents with their two children. So the financial ratios that we'll be looking at are one, profitability. And let me just explain on profitability. You would want to know how this company that you're assessing is performing. or has performed in the past. So that it gives you an idea of the future, and that is your interest. So one of the things that you'll be looking at will be one, the gross profit margin. On the gross profit margin, your area of interest, and why you need to look at gross profit margin is because no other costs are as important as cost of sales in an organization, the COGS. Why? Because the cost of sales are regarded as direct costs. So if in the previous years, and they are not supposed to change drastically or dramatically, because these are direct costs, these are costs that are being matched with your revenues. You have to incur those costs to generate revenues. Without those costs, you will not generate revenues. And this is why the gross profit margin is very key. So you check in the exam, mostly they'll give you just for the previous years. Maybe just 1 year in comparison is fine. But in real life, in the corporate world, we normally go to even about 3 years. For me, I even do 4. So you will see the numbers are expected to be consistent, at least as a percentage of revenue. You are not looking at the quantum. When you say, no, we have the gross profit margin of $300 million or more, it doesn't make any sense at all. We had 300 million more than in the previous period or whatever. It doesn't make sense. It's an absolute number. But if I say the gross profit margin in the period under review was 70%, whereas in the previous period, at the same time, in the previous period, in the same period, or in the previous period, the gross profit margin was 80%. So all I'm saying is, in the previous period, from the one puller or one kwacha that was generated in revenues, the gross profit was 8 ngwe. This time around, it has reduced by 10 ngwe. It is now 7 ngwe. So the question is, what could have caused this problem? Because these are direct costs that we expect that the numbers, at least in percentage form, they should be the same or closer. So now as an analyst, I'll need to start digging deeper, like a Pentecostal pastor, dig deeper, Papa. So I'll need to dig deeper. The question is, have they omitted certain costs by error? Are certain costs being capitalized, which should have essentially been expensed? Have they changed the accounting policy? But if they have, did they actually disclose it in the financials? Because there should be a disclosure when you change your standards, you change your estimates, the way you estimate things. Was it because of inflation? The materials now, they are costing more than they used to. If say it was at now 70 gross profit margin. Could it be that the materials where they were buying them, they have closed, or they closed, and now they are buying materials from some other places outside the area of operation, maybe sourcing them from international markets. And I'm asking this pertinent question because my analysis is not coming from anywhere else other than the formula that gives me the gross profit margin. So those questions that I've already asked Tim, they are coming from the numerator of the formula, the cost of sale, the thing. I need to know what makes up gross profit margin. It is revenue minus cost of sales. So even when I'm asking these questions, if the gross profit margin has been affected, what it means that it's either the revenues have reduced, what could have reduced those revenues, or the costs have increased. What has increased those costs? Did the government suddenly, through their parastatals, flood more cheaper materials for their subsidiary companies or for their companies under the armpits? That now, as we're in the private sector, we are actually having problems because the government has crowded us out. So that would be on gross profit margin. So always look at the formula, use that formula to do your mind mapping and get the factors, get the reasons. Secondly, it would be on using the operating profit margin. Under the operating profit margin, I'm bringing now in new nuances that I need to use for my analysis. One of those data sets, which was a part of the gross profit margin, because on gross profit margin, I just want to talk about the direct cost and the revenue. Under operating costs. And again, the other thing is that under gross profit margin, I do not expect one-off costs when I'm talking about gross profit margin, because I expect that these are direct costs. These are costs that are directly attributable to revenue generation. But then when I go to PBIT, operating profit, which is profit before interest and tax, divided by revenue, obviously, my area of interest there is on operating expenses. Period costs. These are costs incurred after a product has been produced. This is where I'll find admin costs. This is where I'll find selling and distribution costs. But in there could be a one-off cost. And that one-off cost could have actually changed the profile of the financials. You should be in a position to filter out data noises. And these data noises, these are one-off costs that would distort your analysis. So once you find whatever number you find, you go deeper in terms of analysis. If you discover a one-off cost, you bring it out, explain why you have these changes, take it out, because in the future periods, you may not have that direct cost. You are trying to give your investor or whoever has sponsored you to doing that, performing that analysis, to have some assurance of some kind. All bad performances, they are caused by certain items, certain elements, and it's your job as a financial analyst to be able to fish out those toxic elements. So this is why now you are doing your operating profit margin. Unfortunately, in your programs, and I don't know why they don't so much concentrate on EBITDA, but EBITDA is a very important component that you need to do as well. Like you have to come up with your EBITDA margin, because that is what matters most. At that point, you are actually looking at operating cash, because earnings before interest, tax, and depreciation, it is basically operating cash. And you get these EBITDA margins, which is your EBITDA divided by your revenue. So to show if your EBITDA margins are going down, then you know that you are actually not generating value. If anything, you are eating up the value. For most of the companies, they have a standard that their EBITDA must be at least 30%. Because it's from that EBITDA that you'll be able to remove your firmed up capex, committed capex. What remains is what you'd call CFEX. If you don't have committed capex, that EBITDA turns out, if you bring in your working capital, changes in working capital, then it gives you what we call CFEX, that is cash flow available for debt service. Then you start now removing debt service. But even when you are removing your debt service, you need to be strategic. You start with the senior lenders. Under senior lenders, what you start with first is interest charges or payments. Secondly, you go to principal or amortization. Thirdly, you go now to junior lenders, who in that case can be the mezzanines. So you go to mezz and you remove your interest, remove your amortization. What remains, one would argue that is what then now you start giving tax and all that, until you remain with what will be distributed to equity stakeholders. So under profitability, those are things that you need to look at. You can also look at ROCE, return on capital employed. And that number is very key, because return on capital employed is your operating profit, which is profit before interest and tax, divided by capital employed. Many are times in real life that organizations apply more capital, yet the returns are going down. For example, if I find that the returns are, say, 10%, ROCE, return on capital employed, yet the cost of capital is 12%, then I know that we are making a loss, because the returns are lower than our WACC, or weighted average cost of capital. Again, I can also look at the treasury bills. So ask myself, if I go to, is it Gaborone or Botswana stock exchange, or if I go to Botswana Reserve Bank and buy treasury bills, which is passive investment, what are the returns? I find that the returns are maybe 17%. So I ask myself, I have a choice of investing this money in treasury bills, in passive investment, where I'll just be sleeping at home all day long, or reading Bloomberg or these other publications, where my money is actually growing and the value is being generated. Or I start a business which is risk and giving me a return less than 10%. So that is what now you start analyzing, especially when you deal with the ROCE. Analyze the ROCE with your cost of capital, analyze the ROCE with your treasury bills. Go beyond there because you are trying to show your professional skill sets. So that is on profitability. There are quite a number of ratios that we'll be looking at there. Then liquidity as well. Profitability on its own, guys, does not make sense. It is possible having a company that is highly profitable, yet cashless, has liquidity challenges. And it's simple. How is this company managing its liquidity, or what we call liquidity engineering? This is based on working capital. So how is it managing the working capital? So working capital engineering, how you play around with your receivables, how you play around with your inventory, your payables, that's liquidity engineering. So liquidity, that is key. How long does cash take? When you have these receivables, payables, and all these other things, how long does it take for it to be converted to cash? So you need to look at all those components. Hello, are you there?
Yes, coach, you're following.
Yes, coach.
So this is why you're dealing with your liquidity. Yes, profitability, the company could be profitable, but it's possible that it has serious financial problems or liquidity problems. And look at profitability. It's ideally looking at accruals, in short. And you know what accruals or matching concept states? That revenue earned must be matched against expenses incurred in earning it. So you will be looking at liquidity as well. Then gearing. Gearing is also another issue. How geared is your company? Because what we expect is that if the company is highly geared, has procured more debt, that debt has pushed its capital base. And for that reason, if they have rightly borrowed, we expect the revenue base to also grow. But if revenue base is not growing, then we have problems. So ideally, we expect, which normally it does not happen with most of these companies, that at the point that they procure debt, we should expect that revenues should start going up. If not in that same year in which debt has been procured, it can be in the following year. Because when they were procuring this debt, they had done projections. But what we normally see when we're analyzing these financials, we find that at the point that they procure debt, revenue base remains the same. Some extent it even starts going down. Then you start asking yourself questions. Did they actually do a proper market research? Why has the demand remained the same, yet they procured this debt? What was the reason for procuring this debt? Was it to maintain the revenue base because they realized that the revenues were going to start going down over time? if they had not reinvested in maintenance and all these other things. So as a professional financial analyst, these are the things that you need to start looking at. And the whole issue about gearing, it doesn't matter. It can even go, and I've always said it, gearing can go to 100%, 120%. In business schools, they'll tell you, no, when gearing is very high, it means that the company is not doing fine. It's not true. So you will need now to use a ratio which I don't see in most of these programs that you guys do. Debt EBITDA ratio. Debt EBITDA ratio. It shows you that how long can it take to fully amortize this debt based on the revenues, based on the EBITDAs or operating cash that we're generating. So for example, if most of the banks, lending institutions, will tell you it should be less than 6 times, meaning 6 years. So it doesn't matter. I mean, when I get my gearing is over 100. Then I use the debt EBITDA, because the problem with gearing, it's just comparing the interest bearing debt against the capital employed, some extent against maybe equity. That is what it is comparing. It is a very dumb ratios. It is down. Are you getting me? Are you getting me?
Yes, Coach.
It's a very down ratio, because what it is doing, it's concentrating on the balance sheet, looking at the equity or the capital employed and looking at the debt. It is blind in checking, because of that data, how much operating cash are you generating, which is your EBITDA. So most of the lenders, and it's one of the covenants when you're borrowing, they will request that the debt EBITDA ratio should be 6 and less. So I don't care if the gearing ratio, like I said, is 120%. Yet my debt EBITDA ratio is 3 times. Meaning that at the current levels of net operating cash that I'm generating, I'm able to service this debt within 2 years or 3 years. It's okay. However, your gearing level helps you to analyze further in terms of risk assessment, because what it means is, if for some reason the demand goes down or there is a new competitor in town, your EBITDA values will plummet, will go down. And because of that, you may find yourself in serious debt distress. So you are bringing out gearing for a simple reason that you want to talk about risk. No, that's a very important ratio. It's like I have assets worth 100,000 kwacha. Then I borrow maybe 120,000 kwacha. So the gearing ratio, only look at 120 divided by my asset base of 100, and you come up with an opinion, imagine. Forgetting that from my salary, I'm getting 200,000 per month. And when I remove my expenses, I'm getting 140,000 per month. I don't know if you're getting this, guys. So one who has looked at the assets, my equity or capital employed, will think I'm highly distressed. until they look at how much I'm making from my salary that is net of the traditional expenses. Look, is it making sense?
Yes, coach, it's making sense.
Thank you. Then here now you have on the activities. You want to check on asset turnover and all these other things. Then we have investor ratios, which we'll look at, which I've told you, debt EBITDA is one of the ratios you should be using. So this document, why I like it, it tells you what not to say and how you should say it anyway. So on profitability, why you're using profitability, like I've already explained, it basically tells you the amount of profit the business is making. Is it enough considering the volume of goods sold? Is it enough to justify the amount of capital invested in the business? How does it compare with prior periods? And your analysis must be that methodical. How does it compare with other firms in the same industry? It is important to be intelligent in your choice of measure and how you bring out your case. So you have these are the ratios that you'll be using under profitability. You may pick just 3 or so, depending on the time that you have, and go into them. After you're done now, integrate, on your conclusion, integrate them with other ratios that you have looked at, so that now at that point you are concluding and you're coming up with a recommendation. This is return on equity. So this ratio, it is also very important. We have 2 types of investors, guys. In any organization, when you look at it, there are 2 types of investors, at least. These investors, they are those that invest in debt. Mostly those that invest in debt are risk averse. And there are those who are risk takers, those who invest in equity. So those that invest in equity are regarded ordinarily that they are the owners of the company. But what they do is they have to first, whatever returns are being made, first they have to give the debt investors. And those that are preference shareholders, who in short, when you'll be looking at the IFRS 9, ideally they are all still debtors, because they are given the preference over you who is an ordinary shareholder. Because it's believed that you who is an ordinary shareholder, you are the one who actually appoints the shareholders, meaning you have the say in the operations, financial and operational policies or trajectory of your company or direction. So here now you're looking at, after you've given everyone else, what remains is what is supposed to be distributed to equity shareholders. So you're looking at that divided by your equity capital times 100, so that you look at return on equity. From the modeling perspective, when you're looking at project finance, we use internal rate of return formula to compute that. So I know you'll be trying these questions, but my interest is on the commentary. So as you go through your income statement, always have a mental tracking system. Look at how revenue is performing, increasing or decreasing. Look at your gross profit, how it is performing in percentage form. If net profit has reduced, like in this case, we're saying this is unusual, as we normally expect more profit if we sell more goods. So what could be those things that have caused a reduction in net profit? What has caused the operating expenses to have increased significantly? Where did they make a mistake? What should have gone to the balance sheet found itself in the income statement, or what? Check if there's any additional information that might affect your analysis. You could find, again, the other thing. Say, for example, you're looking at return on capital employed. You find that return on capital employed has gone down. There could be a number of reasons. One of them is that in that year under review, management bought an asset, maybe to the tail end. At the tail end of that particular fiscal period, they bought an equipment. So, meaning that the capital employed as a denominator increased. It could also mean that the acquisition of this new equipment, the technology is different, is new. And your people who are supposed to operate those equipment, they first need to be taken for training. There's some learning curve effect. So you need to look at all these other things. So I say, but consider the effect of the disposal equipment. So you need to look at all that. With the material loss on disposal included in expenses, sometimes the capital employed base could have increased, therefore affected your return on capital employed. And the increase in your capital employed could have just come in, set in, not because you acquired more capital, no. It could have just been a revaluation. So look at that revaluation. If you see it, do your analysis, remove it and check on the numbers against the previous period and analyze and go deeper into all these other things. I've always asked my students that, because financial analysis is always there, I've always told them, please, when you see that, just go for it. But day before you go for this exam, read this document. Know what to write, know what not to write. Am I going deep?
Yeah, it's okay, Coach.
Go deeper, Papa. The Bushiris. And Angel what from Zimbabwe? Angel what?
Hubert Angel.
Yeah, Hubert Angel. Is the father to Bushiri, eh? Spiritual father.
Yes. Yeah.
Okay. So I'm going deep. I'm going deeper. So after you calculated the ratios, first spot the differences. Spot the differences. After you've calculated the ratios, finally proceed to analyze the profitability of the company in accordance with the requirements. Here, like you're saying, there's no correct figure for gross profit or net margin. Usually, the higher the better. Maybe in the standard, that industry, they have a certain margin. And if your margin is below that standard, then maybe you can say there are problems, obviously. because then it becomes difficult for you to compete when other companies within the industry, within your industry, are generating value. So the more normal levels vary from one industry to another, useful comparison can be made from one period to the next or against the industry average, like I've mentioned. So pay particular attention to trends and dig deeper and check what is causing these trends, these numbers to change from one year to another. Markup is always based on cost prices, whereas margin is based on selling prices. This I explained last time. ROCE is a very powerful ratio, but I told you, it's more vulnerable to even creative accounting. Because if the board awards management based on the returns, it's very easy to manipulate ROCE. Extremely easy. We'll be just selling assets or lease them back. By the end of the year, after we have used them, then we lease them back so that they are not part of the equation that we are looking at. Or dispose them so that we have a smaller denominator. Or revalue downwards. You see that? Or revalue downwards so that your capital base reduces, and because your numerator remains as is, your operating profit, then your ROCE grows. But those are the things you as an analyst, as an independent analyst, you're supposed to dig out. So you're saying in a business, investing in a business is riskier than a bank deposit. So the business should earn a ROCE sufficiently in excess of the return available from bank deposits accounts to compensate for the risk being taken. They are looking at bank deposits, but obviously in these countries where we come from, bank deposits don't get enough. All you need to compare should be treasury bills. So if you find that the returns you are getting, your ROCE is lower than your treasury bill, the returns you get from treasury bills, they just know that there's a problem. Then the question is, why are you wasted your time to invest in this company and get an 8% return when you should have just bought government bonds or treasury bills and make a return of about 15%? Victor, are you getting this point? So in addition to the business as borrowings, the ROCE should exceed the cost of borrowing. So you need to look at the weighted average cost of capital sometimes, but look at the cost of borrowing. If your cost of borrowing, say, is 9%, and you have ROCE, which is about 6%, what it means that you are not generating any value. ROI, that is return on equity. I already explained on these things. So these are the things that you can do your recalculation and just check. Now, my interest is on weak analysis of profitability ratios, on just ratios. Look at it, how people get it wrong in the exam. They come out from an exam room and they're saying that I got some good marks on this particular topic on financial analysis, but most of the time they get it wrong because of how they do the analysis. One would say gross profit margin and net profit and net margin have both declined, although not by much, and ends there. Who doesn't know that it has declined? Even just my kid who is 6 or 7 years old, you'll be able to see that there's a difference. This one is up, this one is down. It does not answer. There is no answer in there. So the company should watch out in case this ratio declines further. Hello? Another bad answer. ROCE and ROE have also declined. Again, the decline is not massive, but if it continues, the company will find itself unable to continue in business. Others would write, overall, the company is quite profitable, although profitability, according to every measure, is declining marginally. I recommend the company look at improving cost control to improve profits. No one can hire such a consultant. And trust me, because I've been an examiner, I've marked quite a number of scripts. This answer is typical of what is presented by some candidates at professional level, but offers almost no value added. Oh, Victor, you saw some value in the responses.
No, there's no value there, just stating the obvious.
The ratio calculation is correct, would win the bulk of marks awarded here. The last point is the best, as it offers some concrete analysis of the reason for the profit decline. Costs have risen disproportionately, and the potential solution control costs better. But still, it's not even sufficient. For me, I need to mark the student correctly. This is the better analysis. Now, check on how you should respond. That's what I was saying. A day before the exam, just sit and read this document. Overall, it appears the profitability of this business. Take note of it appears, because in the exam room, you haven't been given sufficient information. Or you can say, based on the limited data set provided, it appears the profitability of this business has declined year on year, despite a 9.4% sales increase from this. To ascertain the likely cause of this, let us examine some popular profitability ratios. You should rhyme like that. And those markers, because they mark a lot of scripts, they will just do like this. Even when you write a lot of nonsense down there. Hello?
Okay, coach.
That's what happens. They get stressed, I know. So gross margin has declined from this to this, while gross profit itself increased from this to this, or to this. As gross profit is made up of sales less. So now it's the formula. Each time you're analyzing, do not forget about the formula, because it's from that formula whether it's going to go up or going down. Those are your drivers for that particular ratio. Use them. So here now, because he is using the ratios, says it seems highly possible that the company's management engaged in price cutting strategies to increase sales. Do not say the management engaged in price cutting. No, you don't know. All you're doing is speculating, but in a professional way, looking at the data. So use the terms it seems. Don't state them as a fact. If so, they succeeded in increasing sales, but the additional margin contributed, blah, 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 blah. This could still be a good business strategy as it is the total. So they go on nicely. However, we are informed that the expenses figure in 2014 was increased by a loss on disposal of 300. So you find that one-off thing and you use it. So like on ROCE, you can see on this basis, 14.5% is still a respectable pre-tax return on money invested. However, this should be judged in the context of the riskiness of the business. There's little means of assessing this risk given in the question. So all you're doing, you're creating doubt in the mind of the marker, or you're trying to tell the marker that based on the data provided in the exam, you cannot assess risk. It's limited. But you are doing a bit of some speculations based on your professional judgment. So if you check on here, you find this one-off cost, which has changed your analysis. But then again, you try to remove it from it so that you see whether the numbers still make sense. So the exclusion of the one-off expense in 2014 would affect the ROI ratio, but it is difficult to quantify this. The reason for the difficulty is that the loss on disposal is likely to have had an effect on the tax charge and all these other things. You go on. So on liquidity, obviously you have the current ratio, you have the asset test ratio. On the activity, that is where you have your working capital ratios and the like. So here as well, mostly students will just get current ratio, asset test ratio, and they'll get that information. But it should be put in a better way. These are bad comments and never use them. Revenue has increased substantially, profit has declined, cash position deteriorated. So this basically is what you have observed, and you put it nicely so that in your analysis now you know what to do. Then bad commentaries. So this is basically weak analysis. Current ratio declined from this to this. This figure should be 2.1. Therefore, it is inadequate in both years. It does not make sense. Asset test ratio has declined from this to that. This is extremely poor. This should be 1:1. Overall, the liquidity of this company is terrible. So these are the terms you can be using on liquidity. Just get from here. It is clear that both liquidity ratios have declined significantly year on year. Then you go on, as the companies in the retail trade and trade receivables are significant, it would appear that most of its sales are for cash with a little sales on credit. You go on, the questions are, what are the causes and what needs to be done to rectify it? Then you bring out those issues. Yes, Moka? I can send, I'm sending a thing. There's someone wants to join us. Let me just Okay. So we're on current ratio. So in the exam, you will not be given enough data. You work with the data that you have been given. And this allows you to professionally speculate. Like in this case, you can see down there, it says, we are informed that the company opened a third retail outlet during the year 2014. This is likely to be the cause of revenue increasing by 41% from this. How would I know what has caused the revenues to go up? I just go in the balance sheet. I check if there was any acquisition, if there was an increase in the property, plant, and equipment. I'm able to even see it down there under capital and liabilities. When I see that there was some huge liabilities that was actually, there was some huge debt that was procured. That debt, I should be able to see it on the first half of the balance sheet through the assets that we acquired. Is it the cash that increased? What really increased? Is it the equipment, property, plant, and equipment? Because whatever debt that I get down, it must have been applied And I should be able to see it in the first half of the balance sheet on how that debt was applied, so that I'm able to say, with the debt that was procured of this so much, there was capital injection, which could have led to revenue increasing. So I'm tying debt to revenue increase. I'm tying, if I see that the company was keeping quite a very big chunk of cash, all of a sudden that cash has reduced by 50%. Then I see property plant equipment going up. So I know that what has happened is that this company has acquired more equipment using the available cash that they had. And because of that equipment, there was capital injection, which could have actually led to revenue increasing. Are you seeing a full picture, guys?
Yes, coach.
And the way I would know that there was a one-off cost, when I do my trending, I find that one line had numbers that were almost at the same level, then it went up. So on that particular line, I can assume that there are some activities that were done which were one-off. And then link them to the performance, link them to the numbers. So they're all this. And this is nice. The most obvious symptoms of the trouble is the increase in inventory levels. Now let me explain on the mechanics of financial statements. Even before I get my calculator, just using what I'm seeing in the financials, I'm able to know what is happening in full. If I see a situation where revenue is going up and receivables are going up, what does it tell me? The revenue is going up, receivables are going up, liquidity is going down.
It means they are selling on credit.
It means they are selling on credit. What then it means is that they are trying to stimulate growth by selling on credit. And possibly it is because of what has been said, their targets, that if they get a ROS of this so much, or whatever target they get, or make profitability, they will be given bonuses. So then they now go and start selling full throttle, change the policy. Maybe only they come up with discounts. They come up with the issues of credit. And when they are chasing those numbers, they forget in doing due diligence on their customers. So usually what you do is that you find that if revenue is going up, receivables are going up. With IFRS 9 now, on financial instruments, you will see a line in the income statement under provision for doubtful debts. You start finding that the provision for doubtful debts starts going up as well. So what it means is that these customers are getting most of the time, most likely, or it appears that they are not even paying. Then, if you see where revenues have remained the same, Trade payables are going up. Inventory is going up. What does it tell you? Hello?
You said revenue going up, inventory is also going up.
Revenue has remained steady, almost at the same level. Stock levels are going up, and payables is going up.
It shows that maybe we are facing competition in terms of our product, or our product is no longer appealing to the customers, and such that we are unable to sell as much as we used to. Or maybe we increased production hoping to increase sales, but the market is saturated, or there are a lot of competitors that have entered the market, such that we have not been able to increase our revenue. And in the same vein, we have now been accumulated a lot of stock that we have not been able to sell, meaning that we don't have enough cash to pay our suppliers.
Thank you for that. The other thing, when you see these numbers, and most of the time, if the business is not using a proper business model, most of the time you see inventory going up, you see trade payables going up. All in all is that that company may be faced with a lot of malpractices. That company may actually have corrupt people in there. The question is, why are they buying things which they are not converting, which they are not using? So it means that that inventory, whatever, is because these suppliers, they're supplying materials and whatever, which is ideally as inventory, and the company is receiving them, but not converting them into productive elements, not converting them into cash. So most likely, if you see companies that are, you study all these companies that are being maybe investigated, you will see that trend, that you are buying things that they do not need. And eventually you start seeing, and this is where your analysis come in. If you start seeing inventory going up, trade payables also going up, you should actually, in your recommendation on your analysis, you should say, this is a bad trend, because eventually those materials will become obsolete and they'll be charged in the income statement. There's one I saw which was very interesting. I was training a group of accountants from Nigeria, a Enugu distribution company. So we are looking at their financials, and this is very interesting. The inventory, it was going up. No, yeah. Actually, what was started happening is the trade payables were up. The receivables, it was up. Inventory was very low, about 4 or 5 days worth of inventory. What does it show you? Whereas the trade payables, it was over 800, believe me, it was over 800 days. Receivables was over 500. So what does it tell you? That's an electricity distribution company, electricity distribution company in Nigeria, Enugu. Victor.
It means that
continue.
It means that their business is not viable. Their liquidity ratio might be an issue there. And maybe they are just depending on government support to stay or to stay afloat.
Yes, actually, when you check on the financial stance law, there is a very huge government subsidy. But again, the other thing is why the inventory days, it was about 5 days. Actually, I mentioned that this is a very risky thing. It shows already the mind of the market, of the stakeholders. The suppliers have stopped supplying on credit basis. Allow you get me? The suppliers stopped supplying on credit basis.
Yes.
But also those that are all the company. Because if you are not trustworthy, you are not paying your obligations. What happens is that even your receivables will also stop paying. So the receivables is up, you cannot go and collect because they don't trust you, you don't trust yourself. You have created a bad name for yourself. And this is what happens even in real life. If you are a bad payer, and everyone gets to know that you're a bad payer, even those that you have actually given money, who promised that they were going to give you, most likely they will not give you. So now it are going to 4 days, and this is a distribution company, electricity distribution company. The risk which was there is that once one substation has a transformer that just blows up, it will take time to rectify it because no one is going to give you on credit. So you find, especially when you find that the trade payables are up there and the inventory has gone down, that is a risk that you should bring out. That now you are known by your stakeholders, by your suppliers, that you are not paying. So they cannot continue giving you on credit. So you exhaust whatever materials you have. At some point, you need to start paying cash. But then what is going to happen is that it will start affecting your revenues. Whenever there is unplanned outage of power, you cannot rectify that in time because you cannot go and get from your suppliers on credit basis. They start demanding cash. Some case they blacklist you. Does it make sense, guys?
Yes, coach.
So on gearing, I actually explained there are different types of gearing ratios you can use: debt equity ratio, debt total capital, interest cover. But all this, like I said, this ratio just shows how risky it is. But for me, it is not a very, you need to link it to your debt over EBITDA, so that you see, you determine whether the EBITDA that you're getting, your net operating cash, is able, how long can it take to amortize that particular debt. Most of these countries, when you look at the debt they have and how much EBITDA they generate, they can take 100 years to amortize the debt. Most of these countries. So like I said, however, too much borrowing increases the risk of the company not being able to meet its repayments. Yes, your EBITDA may be adequate, and that debt can be amortized within a short period of time, but the challenge may actually come in if there's a new competitor on the market who then distorts your comfort of generating steady cash inflows. You then move from 0 to 0, and you get exposed. So this was saying, too much borrowing increases the risk of the company not being able to meet its repayments as they thought to. It's just the risky thing that you're looking at. So we have all activity or efficiency ratios. These are asset turnover ratios. You want to see per every dollar that you invest, how much sales are you generating? Here it is ignoring the cost, and this is why whenever you're having this, you're just trying to show how much revenue you're generating, but does not tell you a lot. It is not telling you whether there's value that's been added or not, based on their cost, because you may have invested in new technology, and your asset turnover may look very low, but what that new technology is doing in terms of reduction in cost and all these other things may be quite amazing. These are the usual ratios, operating cash. Then we have investor ratios on earnings per share. So every ratio, just get to know the formula and you use this to analyze what is happening. Muka, you're welcome.
Thank you.
Okay. Ideally, these are the ratios, guys. Luke, Victor, we are joined by Muka. Muka is in Zambia. Now we have 3 countries now.
Okay.
Yeah.
Welcome, Muka.
Muka, Luke is in Botswana. Victor is in Zimbabwe. We're purely Pan-Africanists, isn't it, Victor? We are creating some Pan-Africanist projects.
Thank you so much for being part of this group.
So Victor and Luke, once they are done with this program, or continue having this academy, will make it grow so that we can have people from different countries, isn't it, Victor?
Yes, Coach, absolutely. Victor, I think we can hear him.
Okay, we can't hear Victor anyway. So ideally, guys, this is on the interpretation of investment ratios. I'll send this document. I'll also send I'll send the PowerPoint presentation. But this document, read it religiously and make sure that in the exam, you first go for financial analysis questions. It's a very nice document. It brings out very key data sets. So okay, Mondays are very difficult to meet. We are meeting on Tuesday. We'll be looking at IFRS 16, which is on leases. On Tuesday, maybe we'll start a bit late. I know Muka has engagements, but I'll try to have a side chat with him and see how best we can help out. Then once we are done with the IFRS 16, we'll go to IS 19. From there, we can now start looking at some few exam questions before. I don't know when you guys are writing. After first week. Is it first week or second week? First week?
Second week.
Second week.
Okay,
second week.
We can now start looking at the exam type questions just to galvanize what we have learned and some new knowledge that will be coming from there. But just count yourself that you have passed this exam. Then we should start thinking of other things. Maybe after you're done this, you can come for top SEMA because you'll be just allowed to do the case study.
Okay.
Yeah.
All right.
And before we close, I know Muka just joined. Muka, we normally do checking out, even in financial modeling, that has always been there. You don't go to a hotel without checking out. So we'll start with Luke. Check out Luke.
Thank you, Coach. It was an enlightening lecture. And thank you for that document. I'll make it my gospel in my go-to document. And I think once I've gone through it, and then I'll also look for some exam type questions to attempt. But so far, so good. It's easier for me to get the basics. And that document is also going to assist me immensely, I think and believe so. Thank you.
Thank you, Luke. Victor?
You hear me now?
Yes, we can hear you now, clear and loud.
All right. Okay, thank you, Coach. Yeah, I think for me, I've gotten the basics, and then I'm liking the document because a new thinking, a new shift has been brought in by the document. When you see these questions, I didn't know that we used to comment sales have decreased, sales have increased. So the way you brought in the document and the way you were explaining, if I go through it constantly, I think I'll be good. I'll be fine.
Sure, thank you. Muka, I know you came in at the tail end, but you can just bring out your story. You can also check out.
Yeah, thank you so much. I think mine is basically just to see how I can just catch up with what you've done so far, the rest with the other team, and so that I'm up to speed, and then so that I'm able to move forward with the colleagues. I think my passion is to see that I'm more proficient when it comes to this subject. When I get into the exam room, I should be excited that I'm going to be one of the top class candidates.
Sure.
Yeah, so I'm happy to join the team, and I look forward to learn more.
Sure, Muka, you're most welcome, and I know you've come at the wrong time, but there's nothing wrong about joining a team. So we'll be doing, I just want us to, by weekend, to start now looking at exam type questions, and this is why I'm saying you've come at the right time. But there'll be certain stages, obviously, the team, Luke and Victor, will try to help you out. In some time, I think, because this platform is open, they may want to be doing their practicing and using this platform, so you can also be joining in, even if I'm not around.
Okay.
So maybe what you can do, Muka, you can send your number to what I'll do. Actually, I'll send it to Luke so that Luke can include you on our WhatsApp group.
Okay, all right.
Okay, and the team, especially now that we are three, what you can be doing whenever you're free time, you just let me know so that I give you access to sharing documents, and you can do your practicing at whatever time that you want.
All right, Coach. Thank you.
Okay, thank you, Coach. But Coach, what we've realized is that sometimes when we want to do that when you are not there, we don't have the rights to share. So we'll give you the heads up whenever we want to use the platform.
Yes, please.
Then you can give us the rights.
Okay. Not a problem. Sure.
Okay, thanks.
Thanks. Bye.
Okay, bye.
All right, cheers, team.
Cheers.
Thank you.
Bye.
All right, thank you.